Hello, everybody, and a very warm welcome to another one of our Back to Basics episodes here on the Working Trader. Today, I thought we'd look at exchange traded funds or ETFs because they have huge amounts of money in them, huge flows in and out, massively invested in and traded. So, I thought we'd have a look at what they actually are and what they contain. So, an exchange traded fund, much like any other fund, is a security comprised of other securities. So an ETF contains stocks and shares or bonds or commodities or well, actually that's called an exchange traded commodity product. But so exchange traded fund is normally going to be stocks or shares. But unlike other funds, these trade on the exchanges throughout the day. So it's kind of in the name exchange traded fund. So you can trade them as if they were stocks and shares, as opposed to like a mutual fund where you can't really do that. Which is obviously something that's interesting for people who are looking for shorter term trading, um, but to do it with these sort of broader funds. And they can be actively or passively managed. So if you ever see something that says a tracker or an index tracker, um, that will normally be passively managed, and they normally have much lower expense fees that you pay. And actively managed will be when there's a fund manager who sort of is actively stock picking. Um, an interesting note is that I think generally speaking over the years, the passively managed funds, the index funds, do better than the actively managed ones. Now, of course, it's not always true. There are exceptions to that. It depends which index you're looking at, which trackers you're looking at. But I think that's interesting and something you should look more into if you find it interesting as well. So what are the risks and rewards of trading with ETFs? Well, I think one of the biggest risks is that they may contain companies you don't like. Um, when you look at something like the S&P 500 index, for example, and the ETFs that track it, they will contain a lot of companies that might not actually be doing that well, but because of the way the index is weighted, the whole index still might be doing well. The problem there, though, is that there's a big risk on just a few companies that are doing really well. If they do badly, the whole direction of the index can turn around. So that's something to consider for traders and investors alike, actually, I think. Um, a reward, I guess, is that you can choose specific sectors. So if you don't want to go into all the effort of picking individual stocks, but you think for some reason that the cannabis industry is going to do really well over the next, whatever time frame it is you're looking at, then you can just buy into an index, or an index ETF, a cannabis index ETF, if you think that's going to be the case. Um, Now, the next point, exposure to leverage or inverse markets. I think this can be a risk and a reward. And I think it's something you really need to look into if you're going to consider trading with these instruments. Um, I guess the inverse markets one can be useful if you're in a country or using a platform that doesn't allow you to short the market. But if we're in a long bear market, or you think we're going to be in a long bear market, or you think the price of a stock or a sector is going to drastically go down, but your platform doesn't allow you to short the market, then what you can do instead is just buy and go long in an ETF which is inverse to the market. So you can get inverse market funds, or you can get inverse to specific company funds. Um, and leverage again, if you're trading on a platform that doesn't allow leverage or doesn't offer you leverage, it won't give you any margin. Um, Trading with a leveraged ETF, so you just you buy into it with cash. The provider's not giving you leverage, but the ETF itself is leveraged. Then again, that gives you access to something you don't otherwise have. But these are really complex products, and I think possibly not for beginner traders, and for anyone in fact who's going to look at trading or investing in them, really look at the details of it and what the small print says and what the function of the fund actually is, because it might not be what you think. And I guess finally, although ETFs may include companies you don't like, the reward is that you don't have to stock pick. It's a fairly passive way of investing or trading. So what are some examples of ETFs? One that's been in the news a lot recently, that's done absolutely fantastically, managed by Kathy Wood over at ARK Invest, is the ARK Innovation ETF. Um, People seem to really like that. It's done fantastically over the last, well, it's always done quite well actually, but over the last 6 months, it's done absolutely amazingly. Um, there's the Spider S&P 500 ETF. So as I mentioned in the indices video, the S&P 500 is the indice, but the way you'd actually buy into it, especially if you're doing it just with a cash account, you do it with an ETF, and there are various ETF providers, and Spider's a big one. I think it's the biggest one for the S&P. And you've got the VanEck Junior Gold Miners ETF. So that's one that looks at the gold mining companies, the junior ones. So I think that's the smaller ones. And VanEck is the provider that offers that ETF. So I hope this video was useful. I hope you learned something about ETFs, and let us know in the comments what you think about them. Thank you very much. Take care. Bye.